Tariffs are taxes on goods coming into a country from other places. Some people wonder if the United States could use tariffs instead of income tax to pay for government programs. To understand this, we need to look at how the U.S. used tariffs in the past, why tariffs are put in place, and how much money they bring in compared to income taxes today. From the 1790s to the mid-1800s, tariffs provided 80–95% of federal revenue. This was before income tax existed. For example, the Tariff Act of 1789 helped pay for the new government and protect early American industries. Back then, the federal budget was tiny, about $4 million in 1790, compared to today's $6–7 trillion. Back then, the economy was simpler. Most people worked in farming or small factories, and there wasn't much trade with other countries. The government collected tariffs on imported goods like cloth, tools, and sugar. These taxes brought in almost all the money the government needed. Things changed after the Civil War, and especially after World War II. As the U.S. grew into a global leader, businesses started trading more with other countries. The government also needed more money to fund big projects like roads, schools, and social security. Income taxes became the main source of funding because they could raise much more money than tariffs. Today, the U.S. economy is much larger, $6–7 trillion compared to $4 million, and more complex. The country buys and sells goods all over the world, and many products are made using parts from multiple countries. This makes it harder to rely on tariffs alone to fund the government. Imports are still important, but they're only about 12–15% of the economy, GDP, while consumer spending and services make up most of it. The government now spends far more on healthcare, defense, and social programs than tariffs alone could cover. The idea behind tariffs is often to protect local industries and bring jobs back home. For example, if foreign companies can make cars cheaper than our companies, the government might add a tariff to make those foreign cars more expensive. This gives our car makers a better chance to sell their products and stay in business. And this helps to preserve workplaces for local workers. Very simple solution, right? But here's the problem. Even if a car is made in USA, many parts come from other countries. This is true for most industries, including the automotive. Take Ford or General Motors. They assemble cars in places like Michigan, but engines, electronics, or steel might come from Mexico, Canada, or China. In 2023, about 50% of U.S. imports were industrial supplies, materials, or capital goods like machinery parts. Tariffs on these imported parts would raise costs for U.S. manufacturers. If a car company pays more for foreign steel or batteries, the price of the car goes up, even if it's made in America. Another example is iPhone, made by Apple, a U.S. company. While it's often marketed as designed in California and final assembly happens in places like China, the components come from a global supply chain. For instance, the iPhone's display screens are primarily sourced from South Korea, companies like Samsung or LG. The memory chips might come from Japan or Taiwan, like from TSMC. And the camera modules could be manufactured in places like Vietnam or China. Even smaller parts like screws or connectors might be imported from various countries. This means that even if some assembly steps occurred in the US, which they typically don't for iPhones, the product still depends heavily on foreign parts. So while tariffs might encourage some production here, they don't fully solve the problem when supply chains stretch across borders. A concept called elasticity means people buy less when prices spike. So a 71% tariff might shrink the $3.8 trillion import pool fast. Then there's the multiplier effect. If steel tariffs raise car costs, consumers cut back, dealerships suffer, and jobs don't grow as hoped. Compare that to income tax, which grabs $2.18 trillion straight from paychecks without twisting trade. David Ricardo's comparative advantage adds another layer. South Korea makes screens better, we design phones better. Tariffs mess with that efficiency, and everyone pays more. Influence on cash-tight families. Tariffs affect people's money differently than income tax. A 25% tax on goods from China could raise a $20 shirt to $25, or bump a $50 pair of kids' sneakers to $62. Small for some, tough for families on a lower budget. Income tax changes with how much you earn. Tariffs hit everyone the same. Politically, it's a no-go. The IRS has collected tons of money since 1913, but tariffs cause trade fights conservatives dislike and giveaways progressives hate. History gives us a stark lesson with the Smoot-Hawley Tariff of 1930. Lawmakers jacked up taxes on over 20,000 imports, hoping to shield U.S. farmers and factories. Instead, other countries fired back, trade collapsed, and the Great Depression deepened. Exports dropped from $5.2 billion to $1.7 billion in 3 years. Fast forward to 2018. Trump's tariffs on Chinese goods pulled in $70 billion over time, but U.S. companies paid 20% more for parts, and soybean exports tanked as China retaliated. Real cases show tariffs promise big, but deliver headaches. Now let's look at the numbers. In fiscal year 2023, the federal government collected approximately $4.47 trillion in revenue. Of this, individual income taxes contributed about $2.18 trillion, accounting for almost 50% of the total revenue. Payroll taxes for Social Security and Medicare bring in another 35%, while corporate taxes and other sources cover the rest. And tariffs? Tariffs collected about $80 billion, which is 1.8% of the budget. That's a huge gap. To replace income tax with tariffs, the U.S. would need to raise $2.7 trillion from imports alone. The country imported $3.8 trillion in goods in 2023. If you divide $2.7 trillion by $3.8 trillion, you'd need a tariff rate of about 71% on every single import to match income tax revenue. But it's not that simple. High tariffs would make foreign goods so expensive that people would buy less of them, shrinking imports and lowering tariff revenue. Studies like one from the Peterson Institute suggest even a 50% tariff would only raise $780 billion, still far short of $2.7 trillion. These numbers don't even account for costs of trade wars. If other countries raise tariffs on U.S. goods in response, it could hurt American companies by making it harder to sell products abroad and cutting their profits. Tariffs worked in the 1800s because the government was small and imports were a bigger part of the economy. Now the budget is massive and income tax pays for most of it. Tariffs could help protect some industries, but they'd also raise costs for companies relying on imported parts, like car makers, and for consumers buying everyday goods. Plus, other countries might fight back with their own tariffs, hurting U.S. exports like farming or tech. In short, tariffs can't replace income tax today. They bring in too little money compared to what the government needs, and the economy has changed too much since the old days. They might shift some jobs around, but the math doesn't add up for funding everything from roads to Medicare. Instead of replacing income taxes, tariffs are better suited to specific goals, like protecting certain industries or addressing unfair trade practices.